All right, so the FOMC came out and decided to raise interest rates by 25 basis points. Widely expected. Key change in the terminology in the statement about now determining whether they should raise rates anymore. So in fact, the odds for rate hikes have dwindled to the point where odds of rate cuts are starting to pick up over the next 3 meetings. So we'll break that down, talk about that. The big news, obviously, is in the financial sector, including in the after hours here. That continues to be the big driving factor behind sentiment. It's produced a bearish day today. In fact, the last couple of days have been bearish. How bearish, of course, that matters in terms of our expectations. So we're going to break down the signals that we've been looking for. We've been so bullish here lately, but we've been kind of lacking in some very important signals that we've brought up before. I'll bring that up again today as to why this kind of move we got in the last 2 days we've been susceptible to this kind of move, depending, of course, on whatever the headline would be to create it. But we've been susceptible to it based off of that conditions we're talking about that have not really supported all those bullish signals. So we'll break that down, some big moves in the different asset classes. We'll take a look at how those relate to the stock market. And of course, our trade idea of the day is stock that's setting up its own bearish pattern and potential to the downside. And we'll talk about how to trade that. And of course, YouTube 10,000 is our goal, 10,000 subscribers. As most of you here that watch the videos are not subscribers, we invite you all to click that subscribe button so you can be notified when these videos come out. With that said, let's go ahead and get started. Today is Wednesday, May the 3rd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right-hand column, including a Market Outlook live video that we do at 3:30 Eastern Time. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. We got to 85 likes. Again, the goal every video is try to get to 100. So if you're clicking on, same thing with that thumbs up icon on the Facebook page, click that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. It's a really big deal for us, is why we always ask. So thank you to those who do like the videos day in and day out, and those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. Again, you can see the S&P made another run at the moving average. Over here last week, it crossed below the moving average by 0.03 of a percent down there, and today we're up 0.04% above it this time. The momentum line again dropping to extreme lows, second time in as many weeks. Near-term line did not stay in bullish territory for very long, even though it got to extreme highs there, and it's down into bearish territory itself already that fast. Not as extremely low as it was last week, so a little bit different from that regard. Filling in the gap from yesterday, and then the long upper shadow again today, kind of second time out of 3 days we've had a little bit of a long upper shadow, which indicates a decline into the close rather than the long lower shadows, which is a rally into the close. So some bearishness from that perspective. The intermediate line still in the upper reversal zone, so we're not threatened yet. The market sentiment line is actually still rising. So if this can be if we can, I mean, this is by definition a bullish intermediate confirmation signal. So you get an oversold momentum line combined with a strong bullish posture. And the near-term line in bearish territory, in this case, a smidgen into the lower reversal zone is not too bad. Technically, this is a very short-term buy-the-dip signal. So if the market does what it does best and buys this dip, and we do essentially what we did last week on Thursday and Friday, if we can rewrite that story, which is a perfect ending to the week last week, if we can rewrite that story this week with Apple and the jobs report out tomorrow night and then Friday, then here we go, right? Here we go to the upside. Of course, you're going to have to overcome, what we already have after hours is some news of bank failures, 2 more potential bank failures from PacWest and Western Alliance. Interestingly, a lot of Western banks are failing here. If you take a look at some of the other indexes, the NASDAQ 100 looks pretty similar. In fact, they all look pretty similar. We're below that. The only one that looks different is actually the Russell 2000. If you see that it got the long upper shadow too, just like everything else. It was actually up on the day, 0.4%. It's not as bearish in its short-term sentiment, but we were never that bullish either. In fact, we formed, that's a pretty bearish near-term peak there. So you actually would expect more bearishness from the near-term line going forward based off that. The momentum line did not drop as far, again, partly because we were up today and off of the lows yesterday. So we'll kind of see how that plays out tomorrow, if it plays out to more weakness. But the high point here would suggest that we'll get a lower near-term, it's obviously a lower near-term high. So you obviously would expect that we'll get lower near-term lows to go along with that. And I would expect that the next near-term low point would actually break you below that intermediate low point. We never really did start a new intermediate run. So technically this is all still part of the same intermediate decline. The S&P 500 obviously has had an intermediate run that hasn't ended. So, this intermediate decline over here that started kind of at the end of February, into March, beginning of March, basically kept going, went deeper for the Russell, and then what the strength wasn't strong enough to offset it, where obviously it was for the NASDAQ 100, which hardly got a decline at all during that the beginnings of the banking crisis there, the regional banking crisis. We hardly fell at all, and now we're up at higher levels. So you can see, as of right now, we are holding a resistance at these strong Fibonacci levels. Here we go. So you can see that for the NASDAQ, it's sitting here at about 13,000 plus or minus, a little bit here and there, but we've tried multiple times to get above these levels. Again, narrative changing levels for the NASDAQ, like the 38% is support for the post-COVID rally, the black line. The 23% red line is the retracement level for the 2009 low point rally, post-2009 low point rally that we've had. The 62% retracement is resistance of the correction. So again, the 38% retracement, there's your 50% up there that we hit. We tagged that level previously in that August peak. And then, of course, the 78% retracement of this current intermediate move that we've been, again, retracing for months. The same decline across the board that we've been tracing everywhere. For the S&P 500, that level is right around 4150-ish. 40 up to 4,200 with that black line, but again, we got above that 50% retracement level of the correction decline, and we failed. Right, we've done this before multiple times. We've gotten up to this point, post that low point there, and now we failed, and we so far have done it again. Now, last time we failed, we didn't drop very far, just to the moving average, and this would be even a lesser decline if the moving average can hold for a support and we can buy that dip, right? Of course, the Russell 2000 is a little bit of a different story, as when you put on its Fibonacci retracement levels. Again, we are flirting with getting back below the 23%. Remember, all the other indexes, it's the same intermediate decline. All the other indexes are up here, flirting with that February 2nd peak and flirting with getting above that 78% level. But the Russell instead is on the other side of things and is flirting with breaking back down. So ending the retracement in both directions, but in this case, ending the retracement with a new bearish impulse move rather than flipping the impulse moves to the upside, which is what would happen if we were to hold that breakout, in this case above about 1950 for the Russell 2000. All right, now let's start taking a look at some of the other charts here. Let's take a look at the weekly chart for the S&P. And again, we had transition candle last week, and if we can close above the body of this transition, really and really get above the body of this of here, we can nullify the potential reversal. And as of right now, we were 41.30 there. We're at 41.33 here. We did get a higher high, and as of right now, it's a higher close, and we'll see how much that goes. We did have a we do have a positive candles. We haven't gone negative yet on this weekly Hakinyashi. We're still slightly above zero, though we are still below the moving average on the S&P 500. Remember, the Russell 2000, again, is a little different story. We are in a death cross already. We are in a bearish PPO, or falling PPO, and we do have a bearish candle, again, below the moving average. But you can kind of see how far down these how big the candle sizes can get on the S&P 500. Looking at the 3 green arrow chart, we briefly had 3 green arrows on the Qs. That's now gone. We have a red arrow on the MACD there. We never did get the 3 green arrows on the spiders, and as of right now, we actually had 3 red arrows on the Russell 2000, and as of right now, we only have 2. The stochastics is still turning higher, but you notice we don't have a trend developing yet in either direction, though it appears that we are closest to forming 3 red arrows in the S&P here, and with what would be a bearish stochastic peak. I've always said, we've always kind of called those phantom red arrows when we don't get in the reversal zone before you turn over, and those tend to be more bearish than actually getting into the reversal zone and crossing below that 80th percentile there. So those are the 3 green arrows. When you take a look at the 2-line version on the S&P 500, again, you can see easily below the 17-day moving average, very similar to last week. MACD is negative and falling. It's still above zero, so we don't have everything that we'd like to see when you're bearish on this particular chart, but you do have most everything, and you would expect, if we continue to stay below the 17-day, that the MACD will cross below zero, because again, that means the 8-day is crossing below the 17-day up here, and you can see the failure there at the moving averages, as well as at the top of the value area as we move back towards 4,000, which is where the 200-day moving average is, as well as the point of control. Remember, IWM is a little different. IWM is already well below its 200-day moving average. It's below its point of control. It's at the bottom of its value area. It's still below its 17-day moving average, which is falling. Barely, but it's falling, and it is below its moving average, and it's below zero. So you do have all the bearish signs on the Russell 2000 that you're lacking on the S&P 500. You're just lacking the MACD crossing below zero. The 8 and 17-day, you're so bearish now that the 8 and 17-day have crossed below the 30-day. So it puts a lot of pressure on the stock when you have those indicators like that. If you look at some of the other oscillators here, you can see both the positive and negative indicators for the S&P are relatively high. The negative is actually still above 25 after breaking up above it yesterday. We had a nice, good breakout pattern going into on Monday. You were breaking nearly above 30, well above 25, and then below 20 in the negative, and you really flipped the script yesterday. The negative indicator jumping back easily above 25 all the way up to 28, and your positive indicator not quite back below 25 yet, but now it is, and with the negative indicator also up there. So of course the Russell 2000 does have the bearish pattern here, but it needs to stay above 30 with the positive indicator below 20 to get the ADX to really rise and get up to strong trending levels. And that, of course, is a kind of a theme here on the S&P. We're just not trending at strong levels. We're back to weak levels. Back below 2, back below 65 means we're back to a weak bullish trend. You still have a positive rate of change, so you haven't flipped that around yet. Of course, your Russell 2000, you are below the cloud. You have a bearish rate of change now, and you have no trend yet. But you can see how we're susceptible to a bearish trend developing. Of course, your S&P, you're back below 50. Last time we got below 50, we did not get below 40. That's why the box is still green there. So we're still in bullish territory in the Russell. You're back below zero. You did not. You kind of touched your toe below 150 down there. Obviously, you didn't stay down there for very long. Kind of similar to this situation that we had here, where you didn't really get below 40 and you didn't really get below 150 very much, and so you stayed green, right, as you went right back up into the upper half of these charts. So we kind of need to see a break below 40 and easily below 150, if not below minus 200, to switch to a bearish trend on this particular chart. And finally, when you look at the Bollinger Bands, you are still in a very, very, very low bandwidth So you still are susceptible to a significant trend to come out of this one way or the other, because we've gone we've had hardly any movement here outside of course the FANG stocks. And after breaking up above the upper Bollinger Band, you're already back into the lower half of the chart. At least you're at least you're not in the lowest quartile, but that's how close you are to the lowest quartile. And of course, your bands inside the Keltner channels again set up for a trending move to develop. And the question is which direction. And obviously, you can expect that the direction, since we're bullish going into this move, and now we have the red dots, you would expect the direction would be to the downside. Of course, that's not 100% odds, but that would be the expectation. That would be the higher odds play. And when you look at this week's range, you look how volatile it's been, and you can see the move, and we're actually down another point in the after hours on the PacWest news and the Western Alliance news, so that's putting some pressure on it. A lot of volume today. We closed at the low of the day. We closed at yesterday's low as well. Again, we're not threatening a new high or a new low yet, so both these lines are down. But again, you'd expect, you've already had the pattern that would set you up for a bearish move here, and we had a temporary like postponement of that, and now the question is whether or not that ends up being temporary, and now we'll get the pattern that that this little break below 70 and the hitting zero would have get the pattern that we would have expected. You can see if we fill in that gap, then then you can see if we don't. In fact, we're kind of we're right at that gap right now in the after hours. So we start to fill that in the pre-market tomorrow morning, heading into the market open. We could feasibly be in the beginnings of a new bearish intermediate run, which again, I've talked about all the bullish signals we've been getting, but the bullish signals that we've been lacking the most has been the breadth involved with a bullish move. We just can't get the new highs and new lows are still very negative. They can't get above zero. You look at when we were here in February, and we had very, very good breadth up there. Except for if you look at, I tweeted this out here. Let me bring up my Twitter account here. For those that don't follow me on Twitter, I do put out more stuff throughout the day, so make sure you follow me here at DavidSettle42. Yes, that is a call out to the Hitchhiker's Guide to the Galaxy for those that are aware of that. But if you look at the breadth here, you can see that this index that you're seeing here in the shaded area is the number of stocks above the 50-day moving average. So here at the end of November, we had 461 stocks that were above out of the 500 that were above the 50-day moving average. That was a good move. That was a good move higher. Even though we didn't get back to that August peak, that was a good move of breadth. Coming off of what was a slightly lower low. Then we got a higher low point, and you can see we got a much higher low point on the breadth as well. We didn't even really break the 50% mark there at what would be 250. We kind of did barely, but not really. Then as we went up to a higher high in the S&P, we did not even come close to a higher high on the number of stocks above the 50-day moving average. And then, of course, when we fell down when the banking crisis started, and we thought, oh, it's only contained the financial stocks. The reality is, we fell below 100. We had fewer than 100 stocks above the 50-day moving average, and they were probably all technology stocks, but of course not. But you can kind of get the idea of just how narrow. Because look how much, even though we had a higher low in the S&P, look how much lower the low point was on the breadth. And then now that we rally back up to that February 2nd peak. We didn't even not come close to that peak on the breadth. We're at 300, so you can see as we've been getting higher highs to equal highs, we've been getting progressively lower highs on the number of stocks above, and now we're back below its moving average. Let's see if it's been updated yet for today. This is the 200-day moving average. Number of stocks above the 200. Let's do the 50-day, and it has been updated. And let's go to just a daily chart, and we'll go out to like 2 years. And you can see here that we are easily below the moving average. And we kind of gotten, I mentioned in my class today that every time we break below, we get one last move up. This one you can see almost got above the average. That one did get above the average there. This one got above the average and got a lower peak. This one got above the average, got below, and then back above, but it's a lower peak. This one kind of didn't quite get back above it before we fell down, and this one got above it to a lower peak. And here you got above it to a kind of an equal peak, and now you're back down. And again, if we start to roll over on this, that's the next, that would be, and same thing with the new highs and new lows. It suggests that the breadth is negative. And when you look at the McClellan oscillator, the McClellan oscillator is back below minus 35, and that's to trending levels of negative breadth. And then you can see the money flow index as well, breaking below 50. So that's a bearish breakdown. It can hang around there for a little bit, but it's generally a bearish breakdown when you break below 50, and that can lead to, again, from a volume and a breadth standpoint, things are kind of looking in the wrong direction for the S&P 500, as has been the case for most of this rally. It's been so narrow in its breadth, despite all the really good bullish signals we've been getting. We haven't been getting the kind of the rubber stamp that would solidify all those bullish signals. And then, of course, the other one that we talked about is the extreme decline on the volatility, which had been so low, down to extreme lows, and the big divergence in the correlation between the VIX and the VVIX. You see how how significantly low that is. That typically sets you up for a bullish move in volatility. And as of right now, it appears that we are starting to get that. The other thing I wanted to bring up was the correlation of the Russell 2000 with the NASDAQ. It's been an interesting development. I tweeted this out last night as well. It's another sign of the lack of breadth here, because the NASDAQ 100, the NDX, is 50% from 7 companies. So the FANG names, Tesla, NVIDIA included, not Netflix, but Tesla and NVIDIA included, all those FANG names, 7 companies make up 49% of the NASDAQ 100. So the NASDAQ 100 essentially is a FANG index, for what it's worth. And you can see, if I were to change this correlation to a quarterly correlation here, look how negative that is. Let me give you some perspective on this. In fact, here, let's do this. Let's change it to a 13-week, because that's what I did in my tweet here. And we can really get some perspective on how rare it is for this to be as negative as it is. Like, you can see the correlation is below negative 50%. You can see the gap in returns here on the NASDAQ versus the Russell, starting with this banking crisis that apparently has not abated. But look at, we don't get this negatively correlated. And the last few times we have, again, this one here led to the beginning of the correction. And I would expect that this would lead to the beginning of another correction. The difference between this correction and the last one is the last correction started us up from being well up above the 200-week moving average and a big gap between the 50 and the 200 weeks. Now the gap is that we're not very far above it, and so this would actually start. This didn't start a bear market because you never did get below the 200-week moving average. Kind of hard to be in a bear market if you're not below the 200-week moving average. Just because you were so far above it doesn't mean the decline to it is a bear, right? It's the decline to the 200-week moving average, which is what a correction is, can be all sorts of sizes, and the size of the decline to the 200-week depends upon how bullish you were when it started. That's it, right? It's not a bear market or anything like that. It's just a matter of, how bullish were you? We were extremely bullish, like literally to the extremes. We were bullish before this correction started. So hence why it looks like it was a bear market just to get to the 200-week moving average. It just was a very, very heavy and deep correction simply because of how bullish we were when we started. We are not nearly that bullish now. So the next move lower to the 200-week moving average will most likely get us through, and that's, in my opinion, the textbook definition of a bear market, when you get below the 200-week moving average and you stay there for an extended period of time. I think the odds of that happening, especially if we were to follow through on a negative week, again, we get a week to close, we get 2-day close like we did last week, then we're good. Because last week was about as picture perfect of a close to a week as you can get. Again, minus the breadth and everything else in the volume and things you would like to see associated with such two really good days in the market. We didn't get those. And now, because of that, we were set up for the type of move we've got in the last 2 days, right? Where it's just hard for the markets to get through resistance and stay there because you're not getting you're getting the generals leading the way, but the rest of the troops are staying behind and they're not following through. It's kind of hard for the generals to win a battle or win a war when they're not getting the rest of the army to fight the battle with them. All right, now let's take a look at what's driving a lot of this price action. Look at gold, this whole banking issue starting at the beginning of the month and then renewing now. It's even more in the after hours. Is really taken off here to the upside, even with a strong dollar. So you can kind of see now it's not this weak dollar that's pushing it, it's the risk aversion that's pushing it higher. Look at commodity prices tumbling in the last few days. Let's look at the last 2 days by themselves because that's where a lot of the weakness occurred. We started the week off with a pretty sideways day, and then the last 2 days have been declines. You can see gold and bonds up, the dollar is down. That contributes a little bit to that strength. High yield, you can see, is also way down relative to treasuries there, and then commodities down 3.5%, with equities down to varying degrees. I mean, this is a risk-off pattern here. Obviously, it's not surprising. Let's take a look at their charts themselves. Let's take a look at gold first. And you can see the breakout back to the upside here, back above the 8-day moving average, close to its highs from a couple weeks ago. Some pretty decent volume there. MACD and stochastics turning up. And you can see from a weekly standpoint, we've already had a pretty decent run on gold. And you can see the MACD histogram has already peaked. The MACD itself is peaked. So I don't see a whole lot of upside. Obviously we can start to retest some of these levels from post-COVID. And at the beginning of the inflationary rally, this is actually more of the, kind of a reaction to the Ukraine invasion here at the early part of last year. But you wouldn't expect to see a large move to the upside, considering most of the momentum was taken already just to get back above the 200-week moving average and get back up to the upside. Obviously, bonds are kind of having a similar. The issue with bonds is if it does move up above the 50-day moving average here, you're looking at a pretty significant, that would be a pretty significant rally. You'd be above the 23% retracement, above the 50-week. There's a big gap in between. We've been converging for so long. And obviously it's not had the big move higher in the MACD itself, like over here or something like that. So it has room to really take off and move up. Of course, if it does, that means you'd have a significant drop in the 10-year yield. And the 10-year yield, that 3.5% mark is a really important level, right? Getting above 4% is bearish from a inflationary standpoint. We haven't had that for quite a while, since last October. Getting below 3.5% is bearish from a standpoint that the economy is just not doing very well. And you can see commodities are reflecting that as well. Look at the big breakdown we've had in commodities here on this chart. You can see they're in a correction. One thing I've always kind of told market scholars in our classes, there's two things that you don't see in bullish markets, among others, of course, but two things you don't see in bullish markets. One is a commodity correction, because that generally is the last thing to correct, right? Generally, it's the dollar, bonds, stocks, and the commodities. So stocks have been correcting since the beginning of last year, and now commodities have been correcting since the end of last year. So that's one thing you don't see in bull markets. And the other thing you don't see in bull markets are bank failures, at least to a significant degree. And obviously we're seeing that, including in the after hours here. So, but the big issue here is that commodities are failing. Again, this is a reflection of economic growth expectations. And you can see that's the issue with the 10-year yield falling below 3.5%, because If the 10-year yield were to continue lower, and you can see the big gap to the 200-week moving average it has, then that would be a reflection again of economic growth expectations just tumbling. Because remember, the overnight rate's at 5.25%. That is like a magnet for the yield curve. That where the Fed sets that rate is a magnet for the yield curve. So it's hanging in there by sticking to that magnet. But once that magnet starts coming down, the yields would kind of be a reflection of that magnet starting to come back down, especially with the yield curve getting as big as it is. When you look at where that yield curve is now, especially when you look at the 3-month yield curve, the 3-month yield, which is at 5.25%, right? Just got raised up to 5.25. So it's reflecting a little bit of odds for a rate hike in June. Not very much. You can see the odds for a rate hike in June. We're at 0% yesterday. They did jump up a little bit here today. They're at they jumped back down to 0% with the news here in the after hours. Look at this. The odds of being at 5.25% in June are only 75%. Like that's where we're at right now. So there's a 25% odd, 22.5% odds that we're going to rate cut in June. That should scream something to you. In July, we are getting a 72% odds of a rate cut in July. That's not the next meeting, the one after. For September, the odds of a rate cut by September, which is pretty much by the end of the summer, August, September, October, a pretty generally volatile time for equities. The odds of a rate cut by then are 93%. So the market is pricing in rate cuts, and we know that the Fed said they won't cut rates. So the only way we'll get rate cuts is if the economy is just going downhill. And you can see that, again, reflected in the commodity correction. And you can see that reflected also in the 10-year yield breaking back down below 3.5%. Now, and we've been talking about that level for a long time, this 3.5% level. But keep in mind that it's not very far, and it's had multiple attempts below 3.5%. There's no magical Fibonacci level there. It's just kind of a round number that the market has been flirting with for quite a while. So here it is. Oops, sorry. Oh, I don't know where that one went. It went way down to the bottom, but it needs to be 35.0. So there's your 3.5% mark on TNX. You can see we flirted with 3.5% multiple times. Getting to it's bullish for equities. Getting below it's not so bullish for equities. And here we are again, appearing like we're making a run back down to the downside. And like I said, the dollar is a function of this. The dollar had been so bullish during the rise in yields, has been so bearish during its decline, or during the when yields stopped moving higher. And now you can see the dollar itself is in a correction mode itself. The dollar had been so bullish to begin with, and yields or bonds haven't followed that yet. So we've had the bull market in the dollar. We have not had the bull market in bonds that typically follows, because that's generally associated with correction / bear markets. We've had a correction. We have not had a bull market in bonds. At least we have stopped the bear market that we've been in, but this is hardly a bull market in bonds. So we still have that big correction to fill, and then the bull market in equities begins if you're looking at this from a long-term perspective. Obviously, from a short-term perspective, we've been flirting for so long, but the key to watch over the next week or two is what we do with that 17-week moving average, and the MACD getting back below its moving average and falling potentially below zero, because that's when things really hit the fan, right? When you're below the 17-week, the MACD is below its moving average, and it's gone negative. That's when it hits the fan. You can see it's not common for it to go negative, right? Usually it's during a correction when it goes negative. You can see all the few instances there. So we are back above the zero level here, but we're not really taking off like we generally do when we're coming off. We've already had the biggest momentum here to that August peak. We had another pretty decent momentum to that November peak where we had all that breadth, right? And we haven't had any kind of momentum the last two rallies towards some very important resistance levels here. This one included the 162% Fibonacci retracement of the COVID decline. So lots of resistance that we can't get through because we don't have the breadth or the strength momentum to get through that. Of course, when you look at the last 2 days from a sector comparison standpoint, again, you can see the risk-off nature. Again, going into, keep in mind, going into earnings for Apple, which will be coming out here after the market closes tomorrow. You can see staples, utilities, staples, healthcare, all outperforming the market. Industrials and staples are kind of doing relatively better, but look at energy and financials, really getting hammered. Energy with the commodity decline, financials, of course, with what's impacting them right now, and that's why you're seeing such weakness in the Russell 2000, because those two areas are more correlated with the small cap index, more so than the NASDAQ 100 especially, or the S&P, where XLK and XLY and XLC would be more correlated with those. Let's take a look at the 12 grid for the sectors here. And you can see on the 12 grid, again, we're not quite there on the light green shading and yellow line, light pink shading yellow line. We are in financials, and of course we've blown through that on energy, and we are in utilities. So we're getting that weakness. We have yellow lines on materials. We have yellow line on industrials. We have a red line on discretionary. So you can see we're on, I mean, that's that bear tag pattern that either starts a bounce or is the beginning of the decline, which with energy stocks you would expect it'd be the beginning of the decline. That's a pretty bearish pattern here that has continued. You got that bull tag, and instead of bouncing, and we were so far below, you would expect that this would be a bull tag that would actually start the move to the downside more so than signify a bounce up, which obviously you have seen we didn't really get all this year. All right, so for our trade idea of the day, I want to take a look at AMD. AMD had its earnings, and it came out obviously not so good. Actually ended up, we rallied into the earnings here, as you can see when I get rid of those tags. We rallied into the earnings, but we closed back below that low point. In fact, we actually opened below that low point. Started to fill in that gap a little bit before coming back down at the end of the day. Obviously, the posture is bearish, but you notice, I mean, as we are easily below the moving average, so 10% or so, you notice that that is not a significant level, like we've been lower, so that's not hardly like a deep level. It is when you're on a bullish trend. The question is whether or not we're going to remain on a bullish trend, whether or not we'll start a more of a bearish run again. You would expect that we would, considering market sentiment is actually still pretty high and has room to come down, and we are just starting on the dark green shading the green line. When you look at it from a weekly perspective, we're just barely starting there too, with the intermediate line turning lower there, coming with the short-term sentiment as bearish as it is, and getting another really extremely low market momentum line. Now, granted, there's 2 more days left in the week, so if we rally off the lows sharply, we can change that, but you can see how we're getting much closer to the 30-week moving average for the potential of a move to the downside and a renewal of a bearish move. You'll see on other charts here in just a minute. Let's look at this weekly chart, and you can see you do have the red line, so you are back below the 10-week moving average. The PPO is rolling over, so the gap is getting smaller. You can see we do have a negative candle, but you can also see that that's not the biggest candle that we've seen over the course of a bearish move. As you can see over to the left, it tends to get bigger. So you can see the potential that is set up for this stock. Obviously, we have 3 red arrows today and spike in volume with the earnings. If I would bring up the chart here, you can see the spike in volume. So that's obviously a bearish pattern there. You look at all the lines broken out, and we are below the point of control. The 8 and 17 day are crossing below the 50-day. MACD is turning back down and starting negative below its moving average. Obviously, with the red arrow, the stochastic's turning back down. Looking at some of the other oscillators here, they're all showing bearish patterns. The DMI, that's a bearish pattern for the DMI, and the ADX is just getting started. The RSI and the CCI, you can see down to strongly bearish levels there. And if you look at the weekly version of this, They're just breaking below their midpoints of their chart, so they're just getting started from that perspective. And then you look at the Ichimoku cloud, and you can see we are breaking below the cloud, strongly negative rate of change, and you have a bearish trend that's just getting going, right? It's just barely getting to the intermediate trend strength. So we are really just getting started here on AMD on a decline. Looking at the Bollinger Bands and the Keltner channels, you can see a bearish signal here too, as we broke below both the lower Bollinger Band with a relatively low bandwidth, much lower compared to the 150-day range. So relatively low bandwidth, and we're breaking below the Keltner channels as well. And the Bollinger Bands actually just barely came inside the Keltner channels. So we would start a new run of green dots here if we get, again, staying below the, starting the move below the Keltner channels suggests that we might get an extended move below the Keltner channels with the Bollinger Bandwidth increasing. So we decided to kind of give ourselves some time on this trade and go out to the other end of the 50 to 150-day window when you're looking at long positions, and then buying the just one strike price. We're buying the at the money strike put, and then putting our stop order there at 50%. Kind of gives you the total risk on the trade ends up being right around half of that, so $750 roughly. But you can see the potential reward if we get down to the 60 level. And if you notice, again, kind of from this perspective, to kind of give you an idea of how far down it can go. I forgot to show you the weekly chart here. You can see how we're just barely getting into a range. So if we were to get down to 49.50, and again, we can roll this, but there's opportunity to get down into this area. This is just one standard deviation, of course. If you're down at 2 standard deviations, you can see the move that it can make. You're looking at about a $5,600 reward for, again, $750 of risk with the stop order getting triggered. Really, really good opportunity for a trade that we've got some time built in, and we have the opportunity to roll and lock in credits if we start. But you can see, look, the MACD and stochastics just turning over, just getting below the 17-week moving average. There's some opportunity here to be bearish for a while on the stock like this. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.